Good morning.
Brian Berge, representing Mayor Eric Adams, present.
Comptroller's Office.
Allison Hirsch, representing Comptroller Brad Lander, and
John Dorsa, alternate designee for Comptroller Brad Lander.
Public Advocate's Office. Borough President Manhattan.
Keisha Sutton James for Borough President, Mark Levine present.
Borough President Brooklyn. Borough President Bronx.
Robert Maraglia, representing Bronx Borough President Vanessa Gibson.
Borough President Queens.
Alan Swisher for Queensborough President Donovan Richards.
And Alan is video conferencing per NYCERS procedures. Borough President Staten Island. Dan, we can't hear you.
Yeah, Dan is on mute, but let the record reflect that he is participating, and if he could just give us a thumbs up to acknowledge.
Yes, I'm unmuted according to my computer, but can you hear me now?
Yeah, you're good now. Thank you.
Okay.
Okay, we can hear Dan, and he is video conferencing per NYCERS procedures. International Brotherhood of Teamsters.
Sorry. Lawrence Bosley, Ruben Torres, Julie Colby for President Gregory Floyd.
Transport Workers Union.
Dave Katzman for TW Local 100 President Richard Davis.
In District Council 37.
Ray Santander for Executive Director Henry Garrido.
We have a quorum.
Thank you very much, Ms. Winery. And I know we don't have a quorum from BERS, but will those participating in the meeting on behalf of BERS please identify yourselves for the record?
So for purposes of the record, while everyone's waiting, I'll just acknowledge that Allison Hirsch and John Dorsa are here, and we'll also serve as BERS trustees.
All right. Well, without further ado, I think let's go ahead and turn it over to John so that we can go through the meeting's agenda today.
Thank you very much, Brian. Just want to say it is a fairly straightforward agenda. We have 3 items that we're going to tackle in public session, the first of which is a quarterly presentation by Steve Meyer. So I'll turn it over to Steve, and he'll lead the presentation and then turn that into the risk presentation, and then we'll move into the asset allocation. And then we have one additional item to take up about joining an investor network. And I think all those things will flow nicely into each other. So Steve, the floor is all yours.
Terrific, John. Thank you. Can you hear me, trustees? Is this on? Great.
And I just want to acknowledge that, can the stenographer just acknowledge that they can hear as well?
Sorry, I was muted. And then if you guys could just state who is speaking before as well, that'd be helpful.
No problem. So Steve, just if you could identify yourself and.
Yep, great. Thank you. Steve Meyer, Chief Investment Officer for the Bureau of Asset Management. Good morning, trustees. I'm going to try to be brief today, though that's challenging for me sometimes. But I'm going to give you a very brief update on what's going on in the economy, how those economic developments are impacting markets and what's being priced in assets. And then perhaps most importantly is actually talk about these 2 factors and how they are impacting the performance of your portfolio. As I said, I'm going to be brief. On the first page, Wilfredo, if you can advance, or Kate, are you doing it? Kate, sorry. Just a couple notes. The Fed is near the end of its current rate hiking cycle. They actually have a meeting today. The market is not expecting the Fed to raise rates again, but there is a question as to whether they'll continue to perhaps price in or reflect that there might be a likelihood of a rate hike on November 1st. Right now, the market or Fed fund futures are pricing in about a 25% chance of a 25 basis point hike in November. But again, they're very close to the end of their hiking cycle. Similarly, the ECB and the Bank of England are both instituting restrictive policy and financial conditions in those economies. Both are near the peak of their official rate hiking cycles as well. The Bank of England actually meets tomorrow. and was expected to raise rates. Now there's about a 50% chance of them raising rates another 25 basis points. They had very good inflation numbers today, where the headline inflation was lower, but the core inflation level was dramatically lower. It was expected to be at 6.8% and came in at 6.2%, which is a very good result for that economy. It's also interesting that, and I have to note this, that the core inflation measure that we have in the States is CPI less food and energy. In the UK, it's CPI less food, energy, alcohol, and tobacco. So we wonder if our brethren across the sea actually have better insights there. Wrapping up in terms of where we are in the inflation fight, the Bank of Japan actually meets on Friday, and there is a potential for some tightening of policies. They've done a little bit in terms of relaxing their yield curve control, which is a fancy way of saying they were targeting 10-year yields at just 50 basis points to keep rates low. They've actually loosened that collar for now between a range of 50 and 100 basis points, and they're about midway through that range. The last comment in terms of global inflation is China is somewhat of an outlier. They're actually struggling with a little bit of deflationary pressures, and they've actually been lowering rates to spur economic growth there. On the next page, just headline CPI here. Remember, it peaked in June of 2022 at 9.1%. It's actually about 3.7% now, which is a great outcome for the Fed, and I think something that we should all be encouraged about. Core inflation, again, ex-food and energy, has been a little stickier in the 4 to 5% range, and that continues to be a concern for the Fed. On the next slide, this is just a look at what's referred to as super core inflation, which has been persistently high, again, in that 4 to 5% range for the last couple of years. And this is basically core services excluding housing. So another thing that the Fed continues to focus on. Just a look at the success that we've had in terms of that process of a spike in inflation and coming down very nicely. In red is the U.S. market. You can see a little bit of a spike up going from 3% to 3.5%, now 3.7% inflation. But again, directionally, it's correct for both the U.S., Europe, and the U.K. Moving over to U.S. employment. U.S. employment has been slowing, but it's still solid relative to monetary policy. Again, we've had over 500 basis points of tightening, and we're about 19 months into that process. So the expectations are for the economy to slow and for the employment growth to slow and for perhaps revert and unemployment move higher. However, average employment has actually increased on an average monthly basis over the last quarter by 150,000 jobs a month, more than enough to replace those new entrants into the workforce. Unemployment also did tick up to 3.8% in August. 100% of that increase in unemployment, however, was due to new people or people re-entering the labor market, which is a positive development as we continue to repair our economy. Real quick on the next slide, just a chart. You can see again, unemployment in white on the lower right-hand side at 3.8%. More importantly, however, is that participation rate at 62.8%. We're not yet back to pre-pandemic levels, but we're getting much closer. And again, I think that's a positive development for our economy overall. In terms of economic growth, and just give you a Reader's Digest summary, U.S. has been stronger than expected relative to monetary policy. The Eurozone has been slightly improving, but still relatively weak. And China has been very disappointing relative to expectations, but in the next chart, you'll see still fairly healthy relative to its global peers. On the next slide, this is a 10-year look at an economic growth chart reflecting just how disruptive the pandemic was. You can see on the left-hand side of the chart, the first 7 years are pretty stable and pretty predictable, maybe with some exception around Japan's volatility. But it really underscores after 2020, March of 2020, the amount of disruption that the pandemic actually created in the economy. Ed Berman and I have talked a lot about this in terms of, is this really a soft landing that the Fed's orchestrating? Is it more along the lines of a return to normalcy? And at some point in the coming months, maybe quarters, people start asking, well, what's next? If we've gotten through the pandemic, do we move back into an area of disinflationary pressures? On the next slide, a quick look at where we are on interest rates. As I mentioned, interest rate hikes are nearing an end both here and in Europe, but interest rates will probably remain higher for longer. given some of the stickiness of core inflation in particular. As I said earlier, China's been cutting its interest rates and easing financial conditions to stimulate growth there. They still have youth unemployment, which they actually officially stopped reporting at 21%. So some real challenges there, and in particular in the property sector of that economy. And Japan is still implementing ultra accommodative monetary policy, very, very low for a very, very long time. On the next slide, you can actually see evidence of that. So look on the far right-hand side, you can see the staircase is up. The Fed's been raising rates, Bank of England's raised rates, the ECB has raised rates, again, starting from a negative rate perspective. And on the very bottom in purple, you can see that Japan still has negative 10 basis points official rates. They've had some inflationary pressures, which they're relieved to see given the deflationary pressures that they've had there previous to the pandemic. So again, they may have to do something at some point. I'll talk a little bit about a performance of some of our Japanese stock holdings, but the currency there is very weak. As the US, for example, has raised rates, the interest rate in Japan, the Bank of Japan hasn't. The interest rate differential between the US markets and the Japanese markets have widened so much that there's a flow out of yen and into dollars. And right now, as of this morning, the yen is trading about 148 to the dollar. And what that is doing for the economy in Japan is it's exacerbating the inflationary pressures as they import inflation because their currency buys less in the international markets. So more to come on that. In terms of U.S. credit spreads and treasury yields, it's really been a tale of two fixed income markets in the United States. U.S. treasury yields, unfortunately, have been moving higher this summer, pushing bond prices lower. The 10 years hit a year-to-date high yield yesterday of 4.37%. The other aspect of the financial markets is that U.S. credit spreads, particularly in bonds, investment grade and high yield bonds, are not pricing a recession, and they've continued to tighten significantly from where they were, say, in the middle part of 2022. In terms of U.S. Treasuries, the yields, maybe take a step back and talk about what Treasury yields and why do we talk about these? People talk about the risk-free rate. The U.S. Treasury curve actually represents the risk-free rate of return in our economy. They're also called base rates, and you hear people talk about, and I'm sure Bud and his team will talk about the increase in base rates make fixed income more attractive and help power the returns of the portfolio. But as the base rates have moved higher, it's actually provided more opportunity for investors to continue to invest and maybe add allocations into the fixed income market. The other aspect of this slide I think is important is we still have what's called an inverted yield curve. Typically in a normal yield curve, and the one on the bottom from the end of 2021 in gray actually is normal. It's got low rates in the shorter maturities moving out the curve. So typically in a normal yield curve environment, you're getting compensated for the increased exposure to inflation risk out 30 years, for example, versus today. Right now, we are experiencing, as of the 13th of September, the upper bar, and that's the red bar. And you can still see there's a little bit of a kink up top where there might be another rate hike coming, but short rates are high relative to longer rates, and that's an unusual and a not normal circumstance, and it indicates at some point the curve will normalize. And that'll happen in one or two ways, or probably both. And I've got Robert Fang, our head of fixed income over there as well. You either see longer term rates move higher, which we've seen all summer, or short term rates start to come down as there's an expectation that the Fed at some point will cut rates. As I said earlier, the Fed's meeting today, there'll be a lot of emphasis and attention paid to the what's called the dot plot or the summary of economic projections. And the reason why we look at that is we try to get a sense for where does the Fed think, what's the consensus among the Fed in terms of where they think Fed funds will be at the end of the year. Well, if it's at today's rate, that means there's not another hike coming. If it's higher or lower, that can indicate whether there's another tightening or an easing coming. Folks will typically also focus on that dot plot or that summary of economic projections to get a sense for what does the Fed expect, where do they think Fed funds rates will be at the end of 2024. And that's basically a key to, or a clue to, how many rate cuts we think we'll get in 2024. Not about the timing, but about the ultimate easing of credit conditions. This slide just underscores some of the things I talked about earlier. Actually, Kate, I was thinking it was one back. really about the yield curve being inverted by 72 basis points. That's actually come down. It was as wide as 110 basis points early in the year when U.S. Treasury prices were actually increasing and yields were coming down. Just a quick look on the next slide, credit spreads. Credit spreads are what you earn for accepting some level of default risk among issuers. So the high yield credit spreads here, you can see 380 basis points, fancy way of saying 3.8%. So if I take the base rates of treasuries that have moved up, and let's say base rates in a maturity are at 5%, and what I typically do is I'll add on that 3.8% of the 380 basis point yield spread to say that in high yield for a certain index or bond, I'm now earning 8.8%. And that's why we talk about base rates and credit spreads. And now you can see why high yield, investment grade, unsecuritized debt instruments such as alternative credit are very attractive now as base rates are higher. Even if they're floating rate and short rates are very high, they're attractive sectors to invest in. On the next slide, just a look at what's being priced in stocks and bonds. As a general matter, stocks have been very strong performance year to date. Bonds have been volatile and weaker on those rising base rates, particularly in the summer. And as I mentioned, we saw a peak in U.S. Treasury 10-year yields yesterday, year to date. On the next slide, we see how that flows through into performance of benchmarks. So if you look at let's look at the second calendar quarter of 2023, you can see it's in black. So the Russell 3000 for that quarter delivered an 8.39% return. The developed market ex-US 2.67. Even the emerging market equity positions are up 90 basis points. Alternatively, for the second quarter of this calendar year, you can see treasuries have struggled. Longer duration treasuries more than shorter duration, but it's been a challenging time in the bond market. Not necessarily a bad time to be putting money to work in the bond market if you expect things to normalize and for conditions to ease or for recessionary pressures to come up and drive rates lower. On the next slide, just a look at equities to underscore some of the things I mentioned earlier. On the left-hand side of the slide, you can see that there's a lot of green. Equities have done well both here and abroad. So let's pick on the S&P 500. You can see that's the second line down in the Americas. So the year-to-date returns have been 15.37%. And because we're a U.S. dollar investor and we're putting U.S. dollars to work, in currency terms, it's a 15.37%, same return. Now let's look down at the bottom under Asia Pac where it says the Nikkei index, that's the Japanese stock index. There it's a different story of a 23.28% return, which means the stock market's up 23+%. But when we repatriate those yen back into US dollars because the yen's weaken relative to dollars, our actual return is only 10.26% for that period of time. So again, those are the two components that we have when we invest in non-US markets, is both the return on the assets or the indices, as well as the conversion back to dollars over time. On the next slide, quick look at world bond markets. On the upper portion of the slide, you can see U.S. Treasury, United States 10 years have actually increased in yield. That's the story I said earlier. They moved up pretty substantially over the summer. In the middle part under EMEA, Europe, Middle East, and Africa, mixed bag, some up, some down. And all the way at the bottom, you can see it in Asia Pacific, those on the far right-hand side, the yield year-to-date change in spreads or yields, they're all positive with the exception of China. And again, because China is kind of out of sync with the rest of the world, they're cutting rates as opposed to tightening financial conditions, and that economy is fairly sluggish relative to expectations. On the next page, just a slide you've seen. This is a 20-year slide. On the left-hand side to the far right of that left-hand slide, you can see that there's a nice process of repair in equities. Again, on the right-hand side, that's the Bloomberg U.S. aggregate. It's obviously a core fixed income measure. It shows it underscores the fact that we had a tremendous drawdown in values last year, 2022, a nice repair in the latter part of the year, early part of 2023. And again, that recent sell-off where it trends down again, and there's been underperformance in bonds. A couple of things in the news to note recently, two primarily. Actually, Ray and I talked about one earlier. We had Fitch downgrade U.S. Treasury obligations from AAA to AA+. A lot of that has to do with the level of deficits that we're running right now. but also some concerns over the debt ceiling and the political process around increasing that was a concern for Fitch. Also, AI, you really can't open a financial publication without reading something about artificial intelligence. There may be some hype around certain names that are focused on artificial intelligence, but we do continue to think that it'll have a significant impact in U.S. and economic growth and productivity over time. So it's definitely something to continue to watch. Couple items, couple food for thought items to look at. So remember back earlier this year, we had some concerns in March and April around regional banks, and they were under distress. And as a result, there's been a decreased willingness and ability on the part of banks to lend money. So that blue slide actually shows the loan creation for 2022, which actually wound up being a little over 11%. So banks were actually making more loans to individuals or corporations, small or large businesses. That on the bottom part of that slide, you can see that year to date, the amount of loans that banks are willing and able to give is much lower. It's below 2%. And that will tighten credit conditions in the economy over time. And we're starting to see evidence of that. So why is this important? On the next slide, you can look at for small businesses, those with less than 500 employees, their primary source of funding comes from banks, and that's about 70%. So it's a significant potential impact as banks pull back from lending on small businesses. On the next slide, we just basically reflected almost half. Sure, Larry, please.
Yeah, so since the banks are getting out of the marketplace, doesn't that give us an opening in private credit? Are there enough firms to pick up the slack or not really?
That's a great question. So there's been a huge increase in focus on private credit, and I do think there are really great opportunities there. And I know that Bud will talk about that when he talks about the strategic asset allocation mix. This is really more specific just to U.S. domestic businesses, small businesses in particular. They don't necessarily have the ability to go into the private markets. There's a fintech or online. I mean, it's less than 7 or 8% of potential opportunities for them to fund themselves. So yes, at the bigger institutional level, I think there's great opportunities there as an investor with higher base rates. Most of those obligations that Tina will talk to and present, those are mostly floating rate. And with short rates so much higher, base rates so much higher, they're really driving a lot of return. Small companies, less so. So on the next slide, the reason why that's important is almost half of the businesses in the United States have less than 500 employers, which means they're going to have trouble getting financing to expand their businesses, to hire new workers, and to innovate, which is, I think, a problem longer term.
Question. So wouldn't that bode well for our fund of funds, our smaller firms?
It might. Yeah, it absolutely might. Sure. In terms of being more local. Yeah, so I know you've got the Grosvenor emerging manager mandate, which I think is terrific, particularly because a lot of real estate's local, and they've actually demonstrated an ability to deliver above institutional returns at that smaller level. So I think that's probably a great area to develop, but it's something that it just doesn't turn on a dime. So it's something to watch. But what I'm concerned about now is this impact and what it might do to the economy over the coming quarters. On the next slide, Kate, this is just, you've heard me talk about the monetary policy and the raise in rates by the Fed having a variable and lagged impact. And that slide basically shows that lagged effect of Fed fund hikes. But as you have the two things, Fed fund hikes biting into economic growth, along with constrained or tighter credit conditions that we just talked about, it could mean that we'll see a faster drawdown or slowdown in the economy. We haven't seen evidence of that yet. I think the resiliency of the U.S. consumer, the COVID surpluses that were built up, the demand for services and experiences continue to drive economic growth much more than the Fed would have expected or most people would have expected. So again, it's happening with a lagged effect. I still think, though, that the economy is positioned to slow. You've got some other things. You've got the UAW strike. You've got a writer's strike. You've got the restatement, the reimposition of people paying their student loans. Those are small things, but collectively, I think they will bite on the economy over time. Maybe just one more slide before I get to the most important aspect of the performance. This slide basically, it's really interesting to see how from on the left-hand side, this is CPI today and how it's gone up and come down, but it's also overlaid with the what's referred to as the twin peaks of inflation in the 1970s and late 70s and early 80s. And this is what the Fed's trying to avoid. They're trying to avoid that two-hump process, which is why they'll probably keep rates higher for longer to make sure that inflation has been tamed and doesn't revert back. Different circumstances in the 70s. There were two oil shocks that really drove most of that inflation. But again, the Fed's cognizant of the fact that the Fed back then perhaps eased or lessened the tightness of credit conditions probably too early. Kate, maybe jump ahead a couple of slides to performance. This is a new slide, so we're going to be throwing a few new slides in here over the course of the coming months. We're trying to improve our performance reporting for the trustees. This is a slide that Dan Hassad worked on and put together, which I think is a little better representation of performance. Obviously, you want to look at the NYCERS total plan, which is the top line. For 3 months, it came in at 2.6% just for the second quarter. More importantly, you want to focus on its performance relative to its policy returns further out. So, 3, 5 years, and candidly, probably 10 years, but we don't have that data reflected here. A little bit of underperformance in the median fund TUCs, which I actually wrote it down as the Trust Universe Comparative Services. And that basically means it's a lot of smaller trusts. Typically, they'll have a higher allocation to private markets, which is why the longer term returns tend to be higher than your returns. Are less constrained. They'll have probably 30 to 40 up to 50% in private assets, whereas the basket clause has limited us to 25%, and now with the change in legislation, there'll probably be more we can do there. On the next slide, just a quick look at public market returns. As I suggested, equities have done quite well for the quarter and for the year, and actually all the way out to the far right over the last 5 years. We had a lot of significant disruption last year. In 2022, which has largely been recovered and repaired. So the year of June 30th, 2022 to June 30th, 2023, you can see that the actual returns in that one-year sector for U.S. equities have been up 18%, which is not a bad outcome. As I mentioned, below the emerging market equity line, you can see that core fixed income, TIPS, which has a relatively high duration, have struggled a little bit. High yield has done better than, say, investment grade because of it's got a much lower interest rate sensitivity or duration, and the coupons are so much higher, you get your money back faster. So those have outperformed. Convertible bonds have performed well. They tend to mirror more the performance of equities than bonds, which has helped. And the ETI, obviously, with an interest rate sensitive mortgage product, is underperformed a bit. And cash is king. We haven't had an allocation to cash, but we always maintain some level of cash on hand to meet benefit payments and private asset capital calls. On the next slide, a quick look at public market excess returns. You can see in the middle portion under 3 months, U.S. equities have actually underperformed the Russell 3000. That's because, and this is on an active basis, we've got 2 active managers that were tilted to value and tilted to small cap, and growth and large cap actually outperformed, which has been a drag on performance. And the hope and expectation is that will revert at some point. I'd say the other thing worth noting is the convertible bond underperformance relative to the benchmark. Our positioning, our cadre of investment managers and convertible bonds, we have a more conservative program, more conservative than the index. So when stocks do really well, we tend to underperform. It's a little more of a defensive strategy, but again, we think that will revert over time. And longer out, the returns look less attractive because the benchmark was changed. So it's not really a fair apples to apples comparison. But overall, on the bottom, your total plan has actually delivered 66 basis points of underperformance. More importantly, at 1 year, 3 year, 5 year, it's all in green. So the outperformance has been significant relative to policy. Next slide looks at net private returns. Kind of a different story. There's a lot of green on this slide, and we're grateful for that. In the one-year sector, core, non-core real estate, it's very sensitive to interest rates, have underperformed. There's a lot in the marketplace about, office and retail or mall space doing poorly. We tend to be underweight, or we are underweight relative to the index, the Odyssey index in those sectors. And John Glusak can talk more intelligently about specific positioning. But again, some challenges there with rates moving higher. Opportunistic fixed income's done well because they're floating rate and spreads have maintained at fairly wide levels. And infrastructure has actually proven to be a good inflation hedge and a strong performer in most markets. And I should also emphasize that private equity has been a consistent performer. If you look at, say, the 3-year return on our private equity book under Anash Kajela and his team, 23.4% returns, 5 years, 15.5%, 10 years, 13+%. So the expectation is for us to outperform public market equities with at least a 300 basis point of illiquidity spread. So good outcome there. On the next page, and I'm almost through, private market excess returns. Again, all positive. The one exception here is opportunistic fixed income, which has underperformed a little bit because there's a range of strategies that we manage in the one-year space. A lot of that has to do with the backup in rates, the fact that there's been a retightening, if you will, of high yield spreads, and these are unsecuritized or raw loans. So a little bit underperformance there. We fully expect that to revert back. And again, get back into a position where the excess returns relative to your benchmarks will significantly outperform over time. And one last slide, just rebalancing for the second quarter. And I prefer to give updates that are a little more time sensitive or timely. But looking back, this is really just a kind of an explanation of what we do. So we go through a rebalancing. Actually, Ed and I and Dan Haas and John Mercerberg and Robert Fang and Chris Holmes on the cash side sit down on a weekly basis at 9 o'clock every Wednesday morning. We look at the position, and we look at it for two reasons. Do we have enough cash on hand, or do we expect to have enough cash on hand for the next couple weeks to be able to meet benefit payments and private asset capital calls? But we also look to see, are we over or underweight specific issues? This is actually a good example to go through today. On the left-hand side where it says we're moving money from, that means we're selling equities, large and mid cap, small cap, large and mid cap, and again, small cap in different slugs, and we're buying fixed income on the far right. And that's basically how we go through that process. As equities continue to outperform and the valuation goes up, the overweights increase. And what we do collectively as a team is we address that by reducing the overweights and adding to the positions that have underperformed. So you basically sell your winners and buy what we think is cheaper, and that's a discipline that we have. And I'm sure Bud and his team will talk about the efficient frontier and how we try to stick to the strategic allocation. We're not tactical. I don't believe we should be tactical. I think it's really hard to do. So when you give us the strategic asset allocation, I believe it's our job to adhere to that as closely as possible. We do look at certain things as like transaction costs, and does it really make sense to move such small amounts of money? But again, we meet and we discuss this, and we go through this process again for cash management and for portfolio rebalancing on a weekly basis. And with that, I know I threw a lot out at you, but any questions or anything I haven't covered? Great. I'll turn it back to Mr. Dorsa. Thank you.
Thank you, Steve. We have and we have the complimentary presentation, I'll call it, which is the risk update by Ed Berman. So Ed, if you could take the podium and walk us through the quarterly risk review.
Thank you, John, and good morning, everyone.
And before Ed starts, I just want to remind the trustees, feel free to chime in, ask questions if there's something that you need clarification on. We have the benefit of having Steve and Ed in the room for our meetings. We should take advantage of that. And we also have our consultants here as well. So just want to remind folks.
Or anytime after the meeting, we'll be more than happy to take any questions or discuss any issues. So we just talked from Steve, and I would say that two themes that I found very much relevant to this discussion. So first of all, Steve went over the performance and the results was strong, especially longer-term results. The system delivered positive total returns and positive excess returns, but that's of course in the past. That's already water under the bridge. The question is, what is happening with your portfolio today? Are there any issues, any problems? And the second theme that ran through Steve's presentation, I would say the uncertainty about the world, the financial system, and the markets. Inflation. So the economy and the markets are still normalizing. So yes, there's always uncertainty, but now there's probably more uncertain than always. So the question becomes, how will your portfolio perform going forward? So there's two themes I want to give you comfort about the state of your portfolio today. And of course, your portfolio is a really complex portfolio. So it's over $80 billion spread across 12 different asset classes. There are 99 public managers and 368 private funds in your portfolio. And the reason I give you all these numbers, if you think about it, there are literally thousands of people touching your portfolio every day, making decisions. It's impossible for us to stay on top of everything, yet we want to have a way of being comfortable position. It's exactly what we're trying to achieve today. So all of it taken together, all these people making decisions, markets, we'll call it risk. And you can see the risk for your portfolio at the bottom of this page, and it's 12.1%, which is down 70 basis points. Probably this number by itself doesn't tell you much. Is it too high, too low? Is it consistent? So I'll try to put it in the context. And of course, our starting point are the markets. So let's start with column 1, which is labeled as market portfolio. And it's simply a very standard blend of a 65 MSCI ACWI, which is the broadest global measure of equities, plus 35% of Bloomberg US Aggregate Index, which is a broad measure of US domestic fixed income. And you can see that the total risk for this portfolio stood at 11.7% at the end of second quarter. So just to remind you, this 11.7% has an interpretation of the expected performance. So 11.7 means that we expect the performance for the system over the next 12 months to be within 11.7% range, plus or minus. And it's about a 15% probability to deliver a higher return, and unfortunately, do worse than that. You can see that its total risk for the quarter was down 70 basis points. And that's entirely the markets. It's nothing to do with the portfolio management. And we know that because the markets are normalizing from that extraordinary period. We know that the VIX index, which is a measure of equity volatility, moved down from 20 to 14 for the quarter. It's quite a significant move. More importantly, the fixed income volatility as measured by the MOVE index declined from 122 to 110 for the quarter. So markets normalizing, risks are coming down, and that's why this market portfolio moved down by 70 basis points to the level of 11.7%. So the next step, we consider the asset allocation, which of course your portfolio is not just simply ACWI and US Ag. We do have about 12 asset classes. Not yet, please. We still need to stay on the previous page, please. Thank you. And you can see in the second column of this table, it says policy benchmark, which is your strategic asset allocation. The total risk for your benchmark, strategic benchmark, is 11%. And that's a good outcome. As we introduce complexity into the portfolio, we expect more diversification, and we expect the total risk to come down. That's exactly what's happening. It's a good check on the asset allocation process. And you can see it's declined along with the markets by 60 basis points. And finally, we arrive to your portfolio in column 3. So now I can put this number 12.1 in context. So the risk of your portfolio is consistent and aligned with the benchmark. The risks are running at a slightly higher level, and we'll dive more into it in a second. And related to that, you can see the second measure of risk, which is active risk. As I keep saying that risk is about the expected performance, we use two measures of performance. There's the total return, which is ultimately the most important, and that's measured by total risk. And it's also the excess return, which comes from the skill of your managers, and that's measured by active risk. So active risk of 2.2% simply means that we expect the excess return for your portfolio to be within plus minus 2.2% range. And of course, with my usual disclaimer, about 15% chance to do better than that and 15% chance to do slightly worse. And I also want to draw your attention to these two charts on the right-hand side of the page, which show the evolution, the historical trends in these two risk measures. Trends are often as important as the level to identify any outliers. And you can see that the relationship between these three portfolios I've been talking about have been very stable over the time. So at the top chart number 1, you see total risk for the market portfolio, your benchmark, and the portfolio itself. You can see that the difference between the three has been very stable, and they trend together with markets. And you can see that the level of active risk, or measure of excess returns, again, has been steady. It came down slightly through the year, and that's a reflection of normalizing market. So at the highest level, from the highest vantage point, everything appears to work as expected. But let's dive a little bit more into these two measures of risk. Let's start with the total risk. Can we have the next page, please? So what you see here on the left, the pie chart on the left, is your strategic asset allocation. So I'm sure there are no surprises here. There are three broad buckets: public equities, public fixed income, and alternatives. And this pie chart shows you the market value allocations. What you see on the right is what we call risk allocations. This is how the risks in your portfolio are distributed. This is also the drivers of your performance, drivers of your outperformance, and unfortunately the drivers of potential downside. You can see how much more significant the equities are. So with only a 45% allocation, 63% of risk is driven by public equities. On top of it, private equity is predominantly US-based. So altogether, you can see that more than half of your portfolio is actually driven by US equity markets, be it private or public. So that's the single most important driver of your performance. Public fixed income, which has a 30% allocation, is shrinking down to 7%. And that's, again, it's a function of much lower risk level. So we don't expect a significant contribution to performance from fixed income, but we expect risk diversification. So we expect fixed income to cushion the blows to the portfolio. It's a stabilizer. There are almost no changes to these pie charts for the quarter. So we'll watch very carefully, just as Steve described. Every Wednesday, we rebalance your portfolio. So the chart number 1 on the left stays fairly constant. There were a few basis point drift for the quarter, well within the rebalancing ranges. The chart number 2, the risk allocation, is driven not just by us, it's also driven by the markets. So there were small changes, but nothing really noteworthy. So everything functioning as expected. And finally, I keep saying that risk is the expected return, so we need to bring it all together. Okay, the next page, please. And that's where we compare the realized outcome, the performance for the quarter, against the projected outcome or risk measure. And it's important to do because ultimately it's a measure of the success of asset allocation. Even though we go through this exercise of strategic asset allocation every 3 to 5 years, and I believe Bart will be talking about it in a few minutes, but it's something we watch in real time. And if we notice any issues, it's something we'll definitely highlight to the board and to your consultant. Starting with chart number 1 in the upper left corner. So the vertical bars represent our risk projections, and the small triangles realize the outcome, the performance for the quarter. So you can see that your portfolio, the first bar, is well within the forecast. So it's a check. You can see that all asset classes were also well within the range. And probably the only mildly interesting chart, and it's a boring chart. I always think boring is good. Like in the risk presentation, boring is excellent. So that's, I mean it in a good way. So the noticeable features, chart number 3, you can see that the equities is pushing slightly high against the range. Nothing really to worry about. We'll have more to say about equities when we talk about excess returns. But broadly speaking, there's no message here, and it's a good thing. Switching to active risk, which is again, can you have the next page, please? It's a measure of your expected excess returns coming from the skill of your managers. Just to remind, the active risk runs at 2.2%. And this chart shows you, first of all, the breakdown of this active risk, the contribution, and also the trend for the last 12 months. So what you see here is a sea of blue color, and blue means private. So almost all of this active risk comes from private assets. The vast majority of it, this solid blue band in the middle, is private equity. And that's, I hope, not surprising to anyone. We benchmark private equity against the Russell 3000. I think all of us understand that's more of an inspirational measure. Private assets behave very differently, they mark to market differently, and they price very differently. Probably a more noticeable outcome that public markets do not contribute much, and that's by construction. So we know that in public equities, large part of managers are passive managers. And with the further diversification, will bring the active risk fairly low. So public equities contribute about 20 basis points towards active risk, and fixed income is barely visible here. So overall, no big changes, it's a check. And much like we did with total risk, we need to compare the performance, the realized outcome, against the risk, which is the projected outcome. Can you get the next page, please? Thank you. Much like the previous chart, starting with chart number 1 in the upper left corner, the vertical bars represent our risk projection. The triangles represent the realized outcome. You see it's check, check, check. Everything within the range. But let me focus your attention on chart number 3, equities. So that's where you see big differences, big deviations. First of all, US equities. The realized outcome, the excess return, was minus 1.3% for the quarter. Our projection was 60 basis points. It's almost twice worse than our projection. Now look at the emerging markets. It's the opposite. It's plus 2.4% excess return versus 1% forecast. So what's happening here? Let's start with US equities. So within the US equity sleeve, you have 12 large managers and 7 emerging managers. There's a fairly broad dispersion in their performance, ranging from a gain of plus 4% to the loss of minus 6%. When in public session, I'm not mentioning any manager names here. But one thing was consistent across all managers. The underperformance was driven by stock selection. In the emerging markets, you have 8 main managers and 4 emerging managers. The picture was the opposite. Every single manager delivered a positive excess return, ranging from 40 basis points up to 5%. All of it was driven by stock selection. It's the opposite of US equities. So what's happening here? And the answer is it's a different market structure. So I'm sure you heard many times about the concentrations in US equity markets with this big 5 companies, Amazon, Meta. They contribute the market, and the top 5 companies contribute about 17% of S&P. So for active managers in the US, no matter what their style, it almost became a simple choice. Do I own these companies or don't I? The single decision dominates the active return. If you move to the emerging markets, the markets are more conventional, I would say. There's more dispersion between the stocks, the correlations are lower, less concentration, It's a more fertile area for active stock pickers, and the results speak for themselves. So we didn't find any bias in our managers. It's not they do something unusual. It's just the way market structure works right now tends to create this outcome. So we've been talking about today's markets, and as unpredictable as they are, tomorrow is even worse. Can we have the next page, please? I can guarantee you there will be a crisis. What I cannot tell you is when, how, and what will drive it. We just went through the pandemic, this war, this inflation. If we were talking 4 years ago, I would not have thought about it. But one thing I can guarantee you, that the impact on your portfolio will play out through markets. Whatever shocks you may experience, earthquakes, flooding, another pandemic, it will be reflected in the markets. So we're not trying to identify the next crisis, but we're trying to cast a wide net across all markets while staying reasonable. So identified 3 main markets, not surprisingly, equities, rates, and commodities. And even though you have no direct exposure to commodities, it is the bloodstream of the economy. We'll eat food, we drive cars, we have power in our homes. Without commodities, the economy will stop. And within each of these 3 buckets, we pick the top 3 markets most important for your portfolio. I'm not going to read the numbers here. You can see what the markets are, what the shocks are. But we went to our risk system bar 1, and we asked a simple question. What would be the worst monthly outcome over the next 12 months? And that's what the results are. So for example, you can see for the S&P 500, we project a decline or gain of 25%. For the European stock market, we project almost a 30% difference. What's important is that the likelihood of the shocks is the same. And I'll tell you exactly what it means in a moment. So when we apply these forward-looking shocks to your portfolio, what do we see? Here, the next page, please. So here's the outcome. There are a lot of numbers, but let me kind of walk you through this table because it has a lot of information. So first, we can see the same 3 buckets, equities, rates, commodities, same markets. You can see the 3 markets within each bucket, the S&P, MSCI EM, the Euro stocks, and the shocks. In column 1, absolute return, we show the total impact on your portfolio. Remember I mentioned that all the shocks have equal likelihood. They all may happen with the same probability. So the higher the number, the more is the impact on your portfolio. Just looking at these numbers, you can judge which of these factors has the largest impact. The one that stands out is the S&P 500, 15.8%. And much like I mentioned before, that US equities is the largest exposure from the risk perspective for your portfolio, going forward, you see the same holds true. It's the US equities that will drive most of your risk. Emerging market equity, MSCI EM, second line, has the least contribution. And that, of course, includes China, which clearly in political headlines, but also China is a slowing economy, presents a lot of challenges in terms of markets and finance. So it's not a bad thing that your portfolio is low on emerging market exposure. In the rates, your exposure to the Fed fund policy, which is line number 4, your exposure to the Federal Reserve policy is actually quite low. And even though it's in the news, it's not as important for the portfolio. And finally, in commodities, it's copper, which is a proxy for the global economy, global GDP, which means that your portfolio has a pro-growth environment. And the last point to highlight on this page, what we look for in a multi-asset portfolio is what we call by fancy term convexity. And what it means is we expect the portfolio to do better on the upside and capture less of the downside. We want this asymmetry of return. We capture the gains, but we cut back on the losses. That's exactly what we see on this page. Starting from the top, you see on the risk on environment, the portfolio gains 15.8%, and the risk off, the losses is smaller. When we're capturing more of the upside, less of the downside, it's a check on the asset allocation and a check on your portfolio. It will function as expected going forward. So I will stop here. I know it's a lot of numbers, but if any questions, I'll be more than happy to go over them.
Any additional questions?
I just did have one question, Ed. I noticed on the active risk contribution that cash appears to be a negative drag. I assume it is true that, I mean, I shouldn't assume, that's why I'm asking the question. Is it true that if we have an actual allocation to cash, that will change the policy benchmark against which active risk is calculated, which would imply a slightly higher active risk relative to policy benchmark?
We not to speak for Bud, of course, but I think it's not huge news, but we are suggesting a small allocation to cash for the benchmark 0.5%. That said, it will not really change this chart any significantly. The reason you see cash at the bottom, which is detracting from risk, it's really more to do with correlations, how cash moves with equities.
Okay, so it doesn't have to do with
It's not a question of
nominal
benchmark.
zero allocation.
It's more a question of a central bank policy, and
Okay,
that's
great.
why it's
Thank you. Thank you. That is a complete answer, and I'm glad my assumption was wrong.
Okay, that's going to dovetail into the next conversation, which is about asset allocation. So, and I just want to point out that I think it's interesting that once a lawyer, always a lawyer, with the, is it true? It's like a deposition here. Is it not true? But we've come to the point of the agenda where we're going to talk about the strategic asset allocation. To remind trustees, both at that are in the room and those that are zooming in, asset allocation is the single most important decision we as a board can make in terms of investments. And that is why we've spent so much time on strategic asset allocation behind the scenes before it even gets to this point. There are ongoing conversations between Steve and Ed and their teams and Callan to talk about the strategic asset allocation and to make recommendations to this board. Ultimately, just to remind everybody, and for those watching this on Zoom, the final asset allocation decision is subject to the board's approval, and it is incumbent on the board to select an asset allocation based on the recommendations that they receive, that they are comfortable with, and that they believe will provide the greatest risk-adjusted return for the portfolio going forward. So that's why this exercise is extremely important, and why we as a board and the 5 systems collectively take this exercise extremely seriously, as this is one of our core functions on the investment, is to select the appropriate asset allocation. So with that said, I hope I have teed that up so that everybody understands the significance. I'm going to turn it over to Bud to kind of walk us through this. And I also want to note, Steve, I believe you probably have some comments too. So either one of you may start, but please identify yourselves once again for the record so that the stenographer can take down the transcript, and the floor is yours.
Great, thank you, John. I'll be very brief, maybe just 20 seconds, just to reflect the fact that we have been working proactively on this since we had the change in legislation, the basket clause increase that Governor Hochul signed into law at the end of 2022. It does give us a less constrained opportunity set, which we think is positive. We worked really closely with Bud and the other folks at Callan. I think we've actually got a really good outcome. It does provide a degree of flexibility, so we've been thoughtful in the process. And just to underscore something that Mr. Dorsey said earlier, this is probably the most important decision that a board of trustees for a pension plan makes, is that strategic asset allocation. And then other aspects of it, which we'll go through working very closely with the trustees, of course, but also with Callan, is the portfolio construction and implementation will flow through that. So I wanted to also just recognize Ed's contribution to the process, and it's been really kind of a great exercise. And with that, Bud, I'll turn it over to you and your team.
was going to say it would be better if we could do it from here, just because we have multiple people speaking.
May I just ask a really quick question before you present, Bud? It's really a question for Steve. Can you please remind me, since we're taking on the strategic asset allocation conversation now, and I know we're going through BAM University and beginning the STAR process, how will the STAR process integrate in, how will the outcome of the STAR process integrate into the strategic asset allocation in terms of timing and so forth? How will that information gleaned from that process be incorporated into this?
Great, thank you for that question, Keisha. So the exercise going through strategic asset allocation is really what gave rise to that was a change in the basket clause legislation. And I don't mean to speak for Bud, but I'd suggest that the Callan may have even suggested to do one given the rise in base rates. I know that there's probably about 30% of public pension plans out there that are going through this exercise because base rates are higher and the portfolio mix probably will change. In terms of the interaction between this strategic asset allocation discussion and STAR, so STAR, it's to maybe take a step back, there was a similar review done several years ago. It was called the Funston Review. And it was really much more internally focused within the Bureau of Asset Management of implementing best practices, more from an operational standpoint and a resourcing standpoint. The idea with the STAR review, the Strategic and Tactical Accountability Review, is how can the Bureau of Asset Management, working with consultants, be more accountable to the will of the trustees, to have better reporting packages, to have better service and support. Are we hitting our mark in terms of what you need? The interaction, as I see the overlap between the strategic asset allocation and STAR, is it may require us to ask for more resources. So for example, if there's a 5% increase in allocation to alternative investments, private equity, private credit, infrastructure, core and non-core real estate, we may need more analysts and investment professionals to execute that. And there are different ways we can get there. So for example, we can just buy bigger pieces of the same deals we're doing, or we can be more diversified and look at medium-sized and smaller managers that have more diversity as well across the portfolio. So in my mind, that's probably the key driver, is a question of resources. And do we have the right team? Do we have the right number of people in place to actually implement the will of the trustees through the strategic asset allocation? Thanks.
All right. Good morning, everyone. It's good to see you all. It's actually has been a full 3.5 years since people from Callan have been in this room, so it's nice to see your faces. And the last time we were in this room, we were presenting the last strategic asset allocation. So we've come full circle. Before we get into the presentation, let me just introduce folks from Callan. I'm Bud Palecchia, joined by Tom Shingler. And on the Zoom is Kevin Machis. Kevin is in our capital markets research group. That area of Callan is the one that puts together our projections for the next 10 years on the asset classes. And he also is the one that runs all the models. Pete Keliotis is also here with us today. He's not going to be joining on this presentation. Pete's head of our alternatives, and he's here for the OFI deals that we're doing later. So if I can get the presentation to be up on the screen. Kevin, can you share your screen and pull up the presentation?
And while we're doing that, I'd like to reflect that Elizabeth Guzman from the Public Advocate's Office has joined us via NYCERS video conferencing procedures.
Thanks, Kevin.
Great. You okay, Allison? All right. So as John and Steve mentioned, we kicked off this project close to the beginning of this year, and we worked very closely with the folks at BAM as well as your alternative consultant, Stepstone. Kevin, if you go to page 2, we have an executive summary here, which is basically going to summarize what we're about to tell you. but we have collaborated with staff and Stepstone. We had a number of conversations with each alternative asset class head at Stepstone to talk to them about what they're seeing in the marketplace, how your portfolio is constructed, and how that might inform our asset. Yes, Allison.
I just wanted to note that Henry Garrido from DC 37 has joined via Zoom for the record.
Thank you. No problem. So Stepstone had shared with us what their expected returns and risks were for the various asset classes. We took that into consideration when we built our customized projections for NYCERS asset classes, but they had to work within our full set. So where Stepstone provided some information, we did not just accept their expected risk and return numbers. We took that information and had them fit into our full set of projections for all asset classes. There was a lot of back and forth with BAM and Callan looking at a variety of different alternative mixes, some that included asset classes that you don't see in the recommended mix. But we went back and forth on a number of iterations. And what you'll see later on in the presentation is a staff and Callan recommended mix that increases expected return, but also simplifies the asset allocation by reducing your exposure to TIPS and convertible bonds. The alternative mixes that we're sharing with you, besides the recommended mix, is also a more conservative mix that has higher allocations to fixed income, and a more aggressive mix that has a lower allocation to fixed income. And then we have a mix that includes convertible bonds, as the risk and return difference between the recommended mix and the mix that includes convertible bonds does not really change all that much, but there are more qualitative reasons why we have the recommended mix without. And let me just say that we've spent months going back and forth on this, so we don't expect you necessarily to make a decision today based on what you see. And you may also say that you don't like the mixes that we have presented to you, so we can go back and run another different mix for you. So this can be an iterative process, and we can make a decision today or make a decision at a future meeting. Sure.
I'm sorry, I'm slow today, but Keisha, I thought of another area, another reason why we're doing the strategic asset allocation today, maybe separate and apart from STAR, is that we typically go through a process where we work with the consultants for pacing plans for the next year in terms of how we're going to allocate money into the private asset sectors, again, private equity, private credit, infrastructure, and core, non-core real estate. And that's typically done at the end of the year. So our hope is if we get again, approval and direction from the trustees, that we'll be able to implement any potential changes in the asset allocation mix into the pacing plans that we will start implementing in January. Sorry to interrupt.
So Bud, before we hop into the actual numbers in the presentation, are you starting from a place of what you're presenting is the proxy for the asset classes a passive with no active premium on it, or is there an active premium? But I'm just trying to understand, when we see the numbers, are we to assume it's, if we just did a straight passive equity product, we would get whatever your equity expectations are, or have you guys factored in any type of active premium? I just want to mentally prepare for what we're going to see and how that fits.
Good question. On the public markets, we just assume the index returns, but on the private markets, there is an expected active component. And that was derived with help from Stepstone on how your portfolio is actually constructed.
Okay, so and I'll just take the next step, and I would assume that any transition costs or anything aren't reflected in this, but we should take that into account when we look at everything too. Okay, so I just wanted to make those 2 points and just clarify that before we hop in. So continue, please.
I would also add, John, for that there is a nod to reality in terms of the existing allocations. So we're not going to look at mixes with illiquid asset classes at vastly reduced allocations from where you are today, because we don't assume in a 3 to 5 year period that you could get there. So it's along the lines of what you're saying.
Yeah, reduce or increase, and you'll see that there's marginal changes. Kevin, if you could flip to page 3. It's been said multiple times already today, but I will reiterate it that for fiduciaries, this is the most important decision that you will make as it relates to investments, as it is the primary determinant of your expected returns going forward. And the asset allocation process is really built on the assumptions that we make for the various asset classes, and then as it relates to the different mixes of portfolios that we'll see. And our expectations are built on a 10-year time horizon. So it's a more strategic study that we're doing here today. As Steve mentioned before, we're not looking as to what the markets might do over the next 6 months or 1 year. It's more for the a 10-year period. We talked about, or Steve mentioned that the asset allocation studies are usually done every 3 to 5 years. And that is true, but it also we also look to make new studies when there are different policy changes, like the one with your basket clause. So that also is a good reason. And when there are big differences or big changes in our capital market projections, and with rates rising so much in the last 12 months to 18 months, there's a big difference in our expected returns for fixed income, which is also going to drive decisions, as well as a good reason why we want to review this study today. Another point we want to make about the expectations is that we're not trying to predict an exact return that we think, you know, the S&P 500 is going to have over the next 10 years. It is more of what we think the median of a range of returns could be over the next 10 years. And we're also more concerned about the relationship between expected returns of asset classes. So that's why we just didn't take what StepStone predicted for their individual asset class assumptions, because it has to fit within our capital market assumptions for all the other asset classes. So that relationship between one asset class and another is very important. A few meetings ago, Ed presented what our capital market expectations were for the next 10 years. So we're not going to get into the detail there. However, Kevin is going to provide a high-level review of the philosophy that goes into our projections, which will help to inform the mixes that we'll see later on in the presentation. So I'll turn it over to Kevin now to talk about the philosophy there.
Thanks, Bud. This is Kevin Matches. So when we are looking at this long-term strategic planning process, as Bud mentioned, we feel that a long-term horizon is really appropriate. And we feel that a 10-year outlook is really great because it allows us to incorporate views about the markets, about the state of the economy, without being overly dependent on what's going to happen over the next year. So, we have a path to get from where we are today to where we think markets are going to be over the long term, and we can talk more about what that looks like if it's of interest. When we come up with this set, it's really important that we understand that we're not trying to make dramatic changes in strategic allocations for long-term investors, such as defined benefit pension plans like yourself. We really want to make sure that the output we're getting from our models is reasonable and makes sense and is implementable. And so, finally, I'll just mention that, often when we talk about the expected return of different asset classes, the first thing folks want to talk about is valuations. But when it comes to the way we do asset allocation, we really are going to look at valuation very closely, but we're not going to allow it to impact expected returns of the different asset classes unless valuations are clearly at an extreme level. And so that, for public equities has been the case in prior years, but actually not so currently. So turning to page 5 here. So what does Callan believe about these different asset classes and how asset allocation should be done? We think that over long-term periods that asset classes do have this tendency to revert back to long-term averages, whether that be for yields or valuation metrics. We believe that it's important to take a conservative approach to setting asset allocation. We know that if we were to have views, and we do incorporate views, but we know that if we have views, we don't want that to be the main driver of your final asset allocation, because there's a huge potential for error, regardless of how good our analysis might be that underpins those views. And so we want to be kind of humble about this whole process. We do believe that there are risk premiums. So Bud was alluding to this earlier, this concept that if you have an asset class that has a higher expected return, we're pretty confident that that implies that that asset class is going to have a higher expected risk. And finally here, that we believe that markets do end up ultimately being rational. It can take a while for that to play itself out, but that over a 10-year long-term horizon that does happen. Some more detail here in terms of how this all works. We have detailed models for the individual asset classes. We've included some of that detail in the appendix. Happy to answer any questions about that. But the point here is that we have a view about how the economy could unfold over the next 10 years, how that could imply interest rates and inflation are going to unfold over the next 10 years. And therefore, it fully incorporates how we think the market and economy could play out over that 10-year horizon. So turning to page 6 here, we really want to emphasize that you should focus on the broad asset classes. And so it's possible to go, more and more levels deeper into individual sectors within some of these asset classes. And so what we really want to emphasize is that it's more important as part of this process to focus on the big picture. And so when we think about, say, growth assets that are going to be the primary driver of your expected return, that's going to be 63% of the asset allocation. When you think about risk mitigating assets, such as fixed income, that's going to be a smaller portion, about 22.5%. And that's what we're really going to be relying on to protect the portfolio, provide some of that downside protection when there is difficulty in the growth portfolio. And then finally, there's this inflation hedging component at 14.5%, that we think can help you preserve some purchasing power when inflation is high. For a long time, a lot of folks question the role of purchasing power preservation, but it turns out in recent years, everybody now sees that there is some value in being able to navigate an environment of high inflation. So page 7 here is where we start trying to get into this concept of the risk of the different asset classes. So here what we're looking at is historical stock market returns. And this chart is sometimes called a distribution or a histogram. But the basic idea here is that on the far left, you have periods for the stock market, individual calendar years that were very poor returns. So for example, 2008, there on the left. And then as you move towards the right, you have very good returns for the stock market, such as 2019. And so what you find here is that the vast majority of individual years tend to be more concentrated in the middle of these outcomes. But there are these very bad or good outcomes in the extremes that we have to be aware of and we have to be prepared for when we're doing asset allocation. So the idea is that, yes, you're trying to capture the middle here, the expected return, but you need to be ready for unusually bad environments and make sure that you can keep to this long-term plan without having to give it up just because you have a bad short-term experience. So turning to page 8, now getting into fixed income. It turns out the expected return is actually pretty easy to project over a 10-year horizon for fixed income. Very difficult to know, what interest rates or the stock market is going to do over the next year. But when you look out over a 10-year horizon and you're looking at fixed income, it turns out that the yield, which is the dark blue for the Bloomberg Aggregate Index to represent the broad U.S. fixed income market, that blue yield is a very, very good predictor of the subsequent 10-year return, which is shown in orange here. And so this really provides a lot of help to us when we're coming up with an expected return for fixed income. And so you can see in the far right of this chart, yields have gone up. And so recent returns for fixed income have been negative, but it also indicates to us that the expected return going forward over the next 10 years for fixed income is much higher than it has been in recent years. Turning to page 9, here we're looking at the standard capital market assumptions from Callan. So these are not the ones that are customized to NYCERS, and we'll show those as well later. But this is just to make the point visually that when you look at the different asset classes with the vertical axis in this chart, expected return, and the horizontal axis, expected risk, we know that we'd like to be up and to the left on this chart. That would be the most desirable here when building a portfolio. But in practice, that's actually very hard to do. In practice, what we see is that as you try to get to that higher expected return moving up, asset classes tend to come with higher risk. And so we do believe that you have to be careful when pursuing that higher expected return and be prepared that it is going to come with that higher expected risk. So page 10 is just a summary of the key changes we made in 2023 relative to 2022. And so I already alluded to some of the things that have been happening. Inflation is higher, and so we reflected that in our expectation for inflation. So this is a 10-year projection. We think that inflation could be high in the near term, but that over a full 10 years, it comes down and it averages out to 2.5%, which is higher than we've had in past projections. For cash, base rates have gone higher, as you've heard. And so we think that a good projection for cash over a 10-year period, the expected return on cash of 2.75% is higher than it used to be. Similarly, for core fixed income, as I've been saying, we think a 4.25% expected return is going to be relatively good and is much higher than it was at just 1.75% last year. So pretty dramatic increase in expected return for 2023. For public equities, a more moderate increase between 0.55 and 0.75% additional return this year. And then finally, the private markets. Generally, we're seeing a commensurate increase in expected return with public equity, with the exception of core real estate. And so, that's about as bearish a view as Callan would express. We did not increase core real estate's expected return this year. And so that does not indicate that we are telling clients to sell real estate by any means, but we do want to reflect that there are difficulties in the private real estate markets. Turning to page 11, here's where we get into your custom capital market assumptions. And so we worked very closely with staff and Stepstone to create these. So thank you to both of them. But when you look at this set, these are Callan's numbers, right? So as Bud has been saying, we didn't just take say X% of return and Y% of risk from Stepstone as their input. What we did was we examined their work, and the way that the process worked in practice really was to look at the excess return of some of the investment strategies that underlie these asset classes relative to what we would see in our standard set, and look at that to build an expectation for your custom asset classes here. And then the only other point I want to highlight on this table here is the comparison of high yields versus your custom convertible bonds allocation assumption here. And what you'll notice is that for convertible bonds, there's a relatively higher expected return and lower expected risk compared to high yield bonds. And so we do acknowledge there, the potential attractiveness of convertible bonds, and that is fully reflected in the numbers you're going to see and how we came to the conclusions we did about high yield relative to convertible bonds. Okay, so page 12 here. Now we're getting into correlation. And what correlation indicates is the potential diversification you can achieve between the different asset classes when you're constructing an overall portfolio. So if you were to see a correlation of +1, the highest possible correlation, that would indicate that returns are perfectly synchronized. When one asset class is going up, the other asset class is also going up. Or vice versa, when that asset class is going down, the other asset class also going down at the exact same time. So there's no diversification benefit, and there's no potential to reduce volatility. If you get to a zero correlation, that's actually very attractive. It means that there's no relationship between the returns of the two asset classes. When one is going up, you actually have no idea whether the other asset class is going up or down. And so that can result in a substantial reduction in volatility. And it's something we really like when we see. Now, a -1 correlation is at the extreme end of where correlation can be. It actually indicates that returns are completely opposite. So when one asset class is going up, for certain the other asset class is going down. And it can actually cancel out volatility entirely. And so, if you see that anywhere in real life, you probably shouldn't believe it. It's actually exceptionally difficult, really impossible to achieve in practice. And so when you see this table at the bottom, that really is a summary of the correlations between the different asset classes using our custom set for NYCERS. And what we take away from this is that fixed income has a very low correlation with equities, and therefore it's an excellent diversifier for your portfolio. Turning to page 13, so this is just a retrospective using our standard capital market assumptions. And looking back over a 30-year history, so it's a pretty long time ago, back to 1993, on the far left here, we asked the question, if you were trying to just achieve a 7% expected return, what kind of risk would you have had to have taken? So this is not how folks actually invested back in 1993, but it says, if you wanted to get a 7% expected return, it turns out this pie chart on the far left shows that you could have invested almost the entire portfolio in fixed income, been extremely conservative, and you still would have gotten that 7% expected return. Fast forward 15 years to the next pie chart in 2008. If you wanted to achieve that same 7% expected return, you now would have had to have put a little over half your portfolio into growth assets, into public equity markets. So not nearly as conservative, and so you're seeing the expected risk tick up as a result in 2008. Fast forward to last year, to 2022, and markets were at a very extreme point. You would have had to take fixed income all the way down to just 4% of your portfolio, and you would have had to put a very large percentage allocation into private illiquid asset classes, such as private equity and real estate. And so we would argue that really would not have been a prudent way for a typical defined benefit pension plan to have invested, and clients did not invest that way. But that's what it would have taken just to get that 7% expected return, a very high level of risk at 16.8% in terms of standard deviation. Now looking at 2023 on the far right, things are much easier than they were last year. In order to get the 7% expected return, you could have a much more reasonable looking portfolio. Now 33% of the portfolio is able to be invested in fixed income and provide that risk mitigation or that downside protection. You have a lower allocation to achieve a 7% expected return in the illiquid asset classes, and overall looks much easier to achieve 7% than just last year. And so that, I think, is going to show through when we look at the NYCERS specific asset allocations that you'll be seeing in just a second. But turning to page 14, there's just one other metric we wanted to define before getting into the proposal for the alternative mixes. Here we look on the left side is the asset allocation for NYCERS. And on the right side is how we translate that into a metric called equity beta. And so each of these different asset classes in the different colors is giving a different contribution to equity beta. And so what you kind of immediately can notice there is that this equity beta metric is not just capturing direct exposure to public equities, such as broad U.S. equity in the dark blue at the bottom right, but it's also capturing the indirect or kind of hidden exposure to equity beta across the different asset classes. For example, private real estate there in the gray color. Because we know that these asset classes tend to move in tandem when equity markets are doing extremely well or extremely poorly. And so when we look at the current target for NYCERS, that equity beta, when you add all these individual contributions together, comes out to 0.69. And it indicates that in an environment where equities decline 10%, you would expect the portfolio to decline 6.9%. And so with that, I'll turn it back to Bud and Tom to go through the proposal.
On page 15, before we get into the alternative mixes, we just wanted you to all to recognize some of the constraints that we employed on the portfolios. You all know that you have a basket clause which restricts the amount that you have in certain asset classes up to 35% now. But on the left, you could see what count towards the basket. Other constraints that we utilized is, as you can see on the right side of page 15, minimum high yield of 5%, tips and convertible bonds, a maximum, a minimum of 2% if included, infrastructure at 2% minimum, real estate at 5.5%, private equity at 6%, opportunistic fixed at 4%, and no hedge funds. Moving to page 16. So here is the cut to the chase here. Page 16 and 17, we are showing 4 alternative mixes, as well as the target mix and where you were as of June 30th in the actual allocation column. The recommended mix, again, is one that staff and Callan came up with that we believe provides a very good alternative to where your current target is. It has a higher expected return and risk relative to the target. It is one that has a reduction in public equities of 3%. It increases core fixed income by 2%. It marginally increases the amount in the basket from 21.8 to 23.7. So again, even though we have a lot of room to work with within the basket, given where interest rates are, the fact that on those pie charts you don't have to reach as much to achieve your actuarial hurdle rate of 7%, we don't think that it's prudent to just load up on the private asset classes. One, because we don't think you need to take that much risk, and two, to Tom's point, it would take a long period of time to get you there, so it's really not realistic. And then finally, the liquid assets increased by 3.5% from 22.5 to 29%. I'm sorry, 25.5 to 29, but we also added an explicit allocation to cash of 0.5 to help deal with some of that liquidity. And it also just really recognizes what portfolio has been constructed in the past anyway. On the right side of the page, you see what would need to occur to go from the current target to the either the conservative recommended or aggressive. And we also have that on the following page that includes convertible bonds. So if you look at the recommended column, again, it would be a reduction in public U.S. equity, global ex-U.S. equity, reduction in TIPS and converts, and then slight increases to the alternative asset classes. The expected return goes from 741 in the target to 750, a slightly higher projected risk, and a Sharpe ratio that's that would be equal to the target. I'll pause there.
Yeah, if I'm not mistaken, though, we'd be potentially increasing the return slightly, but we'd be also increasing the illiquidity. Yeah, can we see the next slide? Because I'm also looking at the equity beta, and they seem to be exactly the same between the target today and what's being recommended. So,
right. Yes, on equity beta, the fact that we are reducing public equity, increasing alternatives, increasing fixed income kind of washes out the equity beta. On page 17, the mix that includes convertibles at the 2% level is showing basically a very similar 10-year projected return and risk, but with a slightly higher equity beta of 0.70 versus 0.69.
So on the convertibles, are you including it wholly in public equity, or is there or are you kind of splitting it in half? Because theoretically it's equity-like, but it's still, I mean, it has both sides. So I'm just trying to understand if it's.
Yep. No, it's 1% is coming from equity and 1% is coming from fixed.
Okay.
I'm sorry, this is, what is an equity beta?
Was the chart that we went over on, okay.
You want to go over it again, Kevin?
Sure. Yeah. So each of these asset classes has a different contribution to this equity beta metric. And so, what we like about this metric is that it's not only capturing your direct exposure to, say, your holdings of the S&P 500, but it's capturing what can happen to these other asset classes in environments that are difficult for equity markets, right? So we know that core real estate is not the same as public equities. We know that high yield bonds are not public equities, but at the same time, we also recognize that environments where the stock market is experiencing a lot of difficulty, those are also environments where these other asset classes can also experience difficulty. And so it creates this kind of indirect or hidden exposure to this single equity factor across the entire portfolio. And so when you translate that into 0.69, you add all of those contributions up across the different asset classes there on the right. It indicates that if you have an environment that's difficult for equity markets, say they decline by 10%, you would expect in that environment, that difficult environment, the portfolio would be expected to decline 6.9%. Another way to think about this is you have those total risk numbers that we were looking at for the different the current target mix and the alternative and proposed mixes. About 2/3 of that total risk really is just explained by this one factor, equity beta. And so that's why we spend a lot of time talking about it, because it really is a huge driver of the overall outcome that the plan is going to experience.
Yeah, and just to add to that, I think Ed did a good job of discussing it using the Barra tool. So you'll see in the risk pages from BAM references to the equity beta of the portfolio. And it is very similar to what we show. It shows a little bit lower, I believe around 0.6 instead of 0.69 for this, but it's a similar concept. And you could think about it, if we take one example, S&P 500, that's my benchmark, and I own the S&P 500 in a passive index. So I'm replicating the S&P 500, my beta is 1.0. So if the S&P 500 goes up 1%, my portfolio goes up 1%. S&P 500 falls 1%, my portfolio falls 1%.
So a higher equity beta is more closely correlated is the word I'm looking for, not correlated, thank you. Correlated with the like S&P than the index, and a lower equity beta is less closely correlated.
Exactly. So even just to flesh it out more, I think this could be helpful is, let's say I have an equity portfolio instead of the S&P 500, I own a lot of high-flying tech and healthcare stocks. My beta is gonna, I expect my beta to be above 1. So general market S&P 500 moves 1%, my portfolio is gonna move, let's say 1.3%. Same thing when the market goes down 1%, I'm gonna go down a little bit more. That's the concept. So it is important too in the context of this portfolio, NYCERS has a return objective of 7%. That's still, even with higher interest rates, that's still a relatively high return hurdle to meet over the long term. So you have to have equity beta. 1.0 is too high, it's too volatile, but you definitely need equity or equity-like risk in the portfolio to meet that return target.
So changing it up a little bit, have we thought about in this exercise emerging market debt? Because and is it attractive? If I look at rates in Europe, if I look at the UK, the rates are very similar to what the US is doing. I'm just wondering about geographical diversification and whether or not we have historically run this as and I don't want to speak for the bond folks, but historically a US dominated bond portfolio. And I'm just wondering if we are in an environment where either maybe not emerging market debt, but maybe developed non-US debt is more attractive. I mean, I know Japan has been flat, but you know, I think about Germany, I think about the UK. Is that more of an implementation issue, or is that something that we should factor into it to an allocation? And I'm not a bond expert by any measure of the any measure period. So you know.
I don't know if Kevin, do you have our expected return and risk for EMD?
Sure. Yeah. So here on page 9 here, we're looking at the Callan standard capital market assumptions again. And so again, expected return is the vertical axis, expected risk is the horizontal axis. And you can see, so global ex-US fixed income, that really refers to developed market fixed income. And importantly here, the currency risk is unhedged in this particular assumption that we're looking at. And so the consequence of that is that the bonds themselves in their local currencies are pretty low risk. But when you translate that back into US dollar, the currencies themselves have much higher risk. And so it creates a lot of risk for the asset class, unless you were to go about some sort of approach that hedges that currency risk. And so that's why you see this pretty high expected risk. And in terms of the expected return, currently relatively low. I think when we do this exercise of updating the assumptions next year, you are going to see that float higher, right? As rates have been moving higher. But in general, what we observe is that the developed markets outside the US, because they have relatively lower growth, have been experiencing relatively lower interest rates, even in this environment where inflation has been rising globally. And so that, I think, can make it difficult for a lot of investors to use non-US fixed income in the developed markets. And so, we've seen a bit of churn over the years of our clients who have tried to do that in the past, and sometimes it's successful, sometimes less successful. But certainly we look at it. And then emerging market debt, you can see that's going to be a little bit higher up above the developed markets, closer to high yield in terms of expected return. But emerging market debt is kind of an interesting asset class in that it has some investment grade countries out there that comprise the index, as well as non-investment grade countries that comprise that index. And so we do tend to think that you could get a result if you're looking at dollar-denominated emerging market debt that tends to be pretty close to high yield. And if you were looking at local currency debt, which is in recent years has grown tremendously, that local currency debt again is going to have that added currency volatility into that asset class. So yeah, that is a good, I think, overview of how those asset classes fit into this set here.
If I can just add, and I agree with that assessment, a lot of times these returns are dominated by the currency fluctuation. Dollar's been strong, but the economy is stronger. And the emerging market, again, I think it was very well represented. They can be either dollar denominated, which basically you get more along the lines of a high yield return, or currency related, local currency, and there's a lot of volatility there.
Let me suggest that additionally, in EMD, there are added risks which are not quantifiable. For instance, much of the excitement about EMD a few years ago was about debt issued by local governments and regional governments in China in the belief that the national government would come in support of that debt, right? Which is now a very questionable proposition, right? So you want to actually look at such things as sovereignty risk and so forth regarding EMD. It makes it a very tricky area.
Yeah, and
who was that just speaking?
I'm sorry, that was Dave Katzman.
to Dave's point, I would say in implementation for any client that chooses to allocate to emerging market debt, we're generally grouping it with high yield in that level of risk and return, and we would advocate for active management. It's not an area where you can use passive management.
And I would just add that over the last 10 years, institutional investors have been pretty disappointed in emerging market debt returns, and a lot of them have taken it out of their portfolio. Where we see it more often than not is where you have a core plus manager that invests opportunistically in emerging market debt. Most of your managers are sector focused, so it doesn't really apply there. If I, just to, sir.
Yes, hi. How do we make money in the convert whereby NYCERS makes money? Yes, sir. Yeah.
And then I can't hear the answers.
I'm sorry, Ray Santander.
Do you want me to? I'm happy to answer that. So typically converts, it's a hybrid security. It's got elements of stocks, it actually more closely aligns with stock market performance than bonds. You can make, we have active managers that actually make decisions in terms of which convertible bonds to buy. There's a beta allocation to that in terms of the expected return based on converting those bonds into stocks, and that moves around. You're actually basically long a call option on stocks. So it's tricky to do. For a lot of institutional investors, there's a better way to get exposure to stocks and bonds on a more direct basis. The bonds would be high yield. And Ed, correct me if I'm wrong, but the correlations tend to be very high between converts and high yield.
Callan makes it 0.98.
Yes. Yeah, and correlation. Yep. Yep.
The only thing I would add, Ray, if this addresses your question, is what? Can you hear me? Yeah. So, if this addresses I think this is what you're asking about. Is you have strategies too that are more focused on buying securities that are closer to what's called the bond floor versus securities that are more equity-like, can be converted to equity. So it does vary by strategy with the risk and return. We are modeling the overall asset class, and Steve was talking about this in terms of performance of the managers you have versus the benchmark. So there is implementation there too. It's generally actively implemented, and managers have different strategies that are more conservative or more risk or equity like. And Robert may want to add to this too.
Robert, can I ask just a comment on any changes to our benchmark in terms of how we position it? We're a little more conservative.
And Robert, can you just identify who you are for the stenographer?
Sure. Hello. Hi, I'm Robert Fang from the Bureau of Asset Management. Great. So when we look at our program, our convertible program, one of the things is that our program kind of has different areas of the broad benchmark that we're modeling it to, that Callan models it to, because what's important is the assumed return, right, of the asset class. That's why it's in the asset allocation. So we want to try to hit that asset allocation, hit that return. A lot of the way the program is structured, and there's not a lot of managers in the space. And what's happened lately, we've seen is we've had to terminate some managers. This was over 6-7 years ago due to organizational issues that we've had. So the program, when you're looking at it in a broad benchmark, is more weighted conservative. So as you saw in those returns that Steve showed, it in an up market where the equity market does well, it's always going to underperform a little bit because it's more conservative in nature. And when markets actually sell off like 2022, we had really big positive excess returns from our convertible managers because they're actually more conservative than the market. So the way the program is set up is, I believe it was set up back in 2008 to try to replicate the broad benchmark by piecing managers together to fit the criteria of the broad benchmark in terms of their strategies. And due to organizational issues that we've had, we've had to fire a couple of managers, and now there's only 2 managers in the space. We started out with 4. So that's why when we do a search, if it stays in the asset allocation, we'll have to do a search and kind of look at the structure of the program and try to mimic the broad benchmark of the program. Answers your questions?
Yeah. Yeah, I have a question also. Isn't it a fact that the convertibles have done well for us, and when the market was down, they did less poorly than did high yield? Is that correct?
Yes, I mean, you've seen it in the return assumptions. So yes, they've done what it's more conservative of a program right now. And I think prior to the last 4 or 5 years, I think they were kind of right near the benchmark. Now the broad benchmark is very flawed. It takes weightings in terms of more than 5% to an issuer. We would never kind of do that for our portfolio. We wouldn't allow the managers to do that for the portfolio. So it's more of a risk measure that we have, and the managers also have a risk measure that they don't like to buy more than 5%.
So can I ask a question, just changing gears to the other asset class that kind of came up in the first slide? So TIPS. They're supposed to protect against inflation. We're in a period of or at least we were in a period of extremely high inflation in context of the last 20 years. Did they do what they were supposed to do? And has it run its course given the way interest rates are now? And I'm just kind of curious if we were, looking back, hindsight's always 20/20. Did we go into TIPS at the appropriate time? We had many years where there was low inflation. Did it make sense? And ultimately, did it run its course? And that's why it's no longer recommended going forward.
Great, that's a great question. So in 2022, we experienced really high inflation, CPI prints. And the one thing we've noticed about 2022 was that TIPS did not do what inflation did. So it outperformed treasuries, but it didn't outperform in terms of the market. Okay, so they still had very negative returns. And so one of the things we saw is that when you look at TIPS, TIPS are still bonds. They still have a duration. They still have a maturity. So what happens is the duration overwhelmed the CPI factors. So TIPS, what they do is they adjust for inflation. That's why they're inflation-protected securities. But we saw that the duration of those bonds actually outweighed any kind of benefit from the inflation side. So that's why we thought that, when we did asset allocation, and Callan could step in on this part, is that we thought there was better ways to replicate that risk, to have it, the inflation protection in the portfolios. TIPS being at 3% really doesn't make a big difference. It's more of an allocation that you would have for treasuries because they're kind of, it was instead of treasuries, you can do TIPS because they're still government bonds.
And Robert, the duration of the TIPS index was, I think, over 6 years, so that drove a lot of the negative performance.
Correct.
It's also how it's benchmarked. Can I ask Ed Berman, our Chief Risk Officer? Ed,
I'm sorry, I didn't catch what you said. How many years? You said
the duration's about 6+ years, and that's why when rates were moving so much higher, the duration exposure, the interest rate sensitivity was negative and overwhelmed any benefit we have from CPI. But Ed had some interesting insights as well in terms of how the CPI is calculated.
Yeah, so one interesting point about TIPS, even though they do protect against inflation, but they actually protect against the inflation expectation. So when we talk about inflation, the CPI print, it's quoted by the Bureau of Labor Statistics, and it measures the prices, change in prices in the economy. It turns out that TIPS, because of the duration element, are not that responsive to the changes of CPI, what we call by inflation. It's what people think an inflation will be in 10 years. That's what drives the TIPS. And anecdotally, it turns out that people think about inflation's highly linked to the oil prices. It's the price at the pump when they fuel up the cars. And we look at the history of inflation expectations, it never actually moved much. So unless we go through a long period of inflation, like in the late 70s, 80s, we do not see the TIPS providing a meaningful inflation protection. At the same time, other asset classes already present in the portfolio, such as real estate, infrastructure, and to some extent public equities, do provide a meaningful measure of protection. So that's why we kind of discussing with Callan, the point was maybe it's more efficient use of capital to replace TIPS with other asset classes.
Yeah, and you've seen with TIPS went down, but the infrastructure and real estate went up a little bit to compensate.
If there are no other questions about TIPS, or are you going to chime in on TIPS as well?
Well, it's not specific to TIPS, but I do think this is an important point on inflation, which is that, and we just saw this, inflation is often unanticipated. And there's different types of inflation that we can experience. So the idea is to build a strategic asset allocation that has components that are responsive to inflation and not trying to time it, where we're saying, well, in the next 6 months, we expect X, so we're going to put on an allocation of TIPS. That does not work for this portfolio. So we're thinking about it in a strategic asset allocation sense and what inflation-sensitive assets, like Ed was just talking about, could potentially have a role.
Sorry, because I just want to make sure I'm understanding it correctly. So if we look at the changes that are potentially being the potential allocations moving forward, the two asset classes that are under discussion, basically to remove from the portfolio, TIPS underperformed, but convertibles overperformed. Sort of benchmark. How did convertibles perform?
Well, there's one thing to look back at performance, and there's one thing to look forward. The historical returns of convertibles has been in line with high yield bonds, but there's more qualitative reasons why we recommended to get rid of them, which we can get into. It's a much narrower market. There's very few active managers in the space. Because it's such a narrow market, we don't want to increase the exposure from 2%. And, some of the questions that we had about the allocations of 2 and 3% is, does it really move the needle? Is it worth it at that level within a strategic asset allocation? Maybe your high yield managers can get exposure to convertibles on a more opportunistic basis. Do we need an absolute allocation within the asset allocation, or can they do it, opportunistically?
Sorry, one follow-up on this. And what if we were to go to that approach, and then maybe Steve, this is for you or for Robert, because it's an implementation question, what would the sort of implementation cost be of sort of moving money out of one asset class into another for the same returns?
I'll defer to Robert on that.
Piggyback on that? because we're asking questions I have the similar questions. That's essentially what I was trying to get to. In addition to the question you just asked, what would the risk of asking or hoping that the high yield managers would be able to operate as effectively as the convertible managers in a different space? I guess is it sound logic to expect a high yield manager to perform as well as a TIPS manager? I mean, excuse me, as a convertible manager?
Okay, so that's an excellent question. Ed and I spent about 4.5 hours with one of our high yield managers yesterday, and we asked a specific question on convertibles in the portfolio. How would they look at it? What do they think is the most efficient way to implement convertibles and high yield in a strategy? Now, we've talked about before that the correlation between high yield and convertibles are very close. So they're not 1-for-1, but they're very close. They're like around 80%. So how we kind of do it is that, we would have a high yield strategy, and right now we currently allow our high yield managers to take an out of index bet in convertibles to add alpha. Now, they're not required to have, if they're not good at it, they're probably not going to venture in, because it could cost them, because it's not part of the index. So any kind of return you have, is more of a risk that's not efficient risk, okay, because it's not part of the index. So when we look at, when we allow them to do that, they could dial it up or they could dial it down. They could if they're good at convertibles, they can either have maximum of 10% right now, or they can have 0. Okay, and what we've seen from the managers is that right now that manager has close to like maybe 2 or 3%, so it's very low, right? And they like it because of the different structures in it. Now, one of the things that Callan had said, which kind of I think influenced their decision, and I don't want to speak for them on convertibles, is that when we look at a space in terms of what we want to get into, we want to make sure that there's enough managers in the space, right? Of course, we look at returns first, right? But then we look at, is there an asset class that can kind of, substitute for it, right? And what we see in convertibles is there's not a lot of managers, because I talked about the program, we had to terminate a couple of managers, and then we had a big white space in our program, right? That we had to, because it fell out of the asset allocation in 2016 and came back in 2020, and then there was a lot of it was in and out of the allocation. It was hard for us to try to get them to do a search, right? So when we did the last asset allocation, we looked for a broad kind of benchmark to kind of hit that assumed return. So what happens is we had to fire a couple managers. We didn't have any replacements for them. So that's part of the reason why I think, from a Callan perspective, there's not a lot of managers in the space, and it becomes more of a defined kind of characters. But we feel that our high yield managers can do convertibles pretty well.
And if I may add one more point, sorry, to Robert's point, completely agrees with everything he said. There's a reason why we keep mentioning high yield in the context of convertibles, and it's not just about correlations. The fact of the matter is there's certain type of companies that issue convertible bonds. It's scientific companies constrained on cash. That's the reason why companies give up the equity upside. It's the same type of companies that issue high yield bonds. So for high yield manager, using convertibles is a natural transition. They already have credit analysts, they already follow these companies, they're already on the quarterly calls, they have an actual management. So it's a natural transition for high yield manager to use convertibles bond opportunistically. And opportunistically is the key. So right now, interest rates are very high, but convertibles being issued with a very low coupon. So they pay very little, about 1 to 2%. High yield in the current environment, it's 8 to 9%. So where it stands today, today's market environment, it's more efficient to go into high yield bonds. Fast forward a couple of years, it may change. It well could be that convertibles offer a better trade-off. So if we give this flexibility to the high yield managers, they'll be able to use this asset class more efficiently. So there's time and place for convertibles, which may not be today.
Yeah, well, I have a question regarding to talk about the sectors, the less sectors for convertibles. But isn't it a fact that those sectors are less likely to default than the high yield sectors that are invested in?
I think that is one aspect that has been proven. Some of the managers that we work with have shown that. But that's just one aspect of, I think what Ed just said is, it's a big difference between what the yield is on high yield versus the yield on convertibles. But on the defaults, you're right.
Yeah,
Yeah,
and as you stated, this may not be the same thing in 5 years from now. So I'm not sure why we should change where we're at, our position, to add more volatility.
So I just want to point out, while we should be doing an asset allocation every 3 to 5 years, and there's an argument that has said we should be doing it once every 30 years and just let it go because we're a perpetual plan. I don't really think that that's a good idea either. I am cognizant that whatever we adopt, when we choose to adopt it, we're going to have to live with it for quite some time, right? So I understand we're looking at we're looking back the last few years. We're trying to figure out, was the appropriate time to have convertibles passed, or tips for that matter, did it pass? But I think we also, as a board, with the advice of and some recommendations from the consultants in BAM, but clearly it's the decision of the board, have to think about the long-term nature of what we're going to be approving when we ultimately approve it. So I think we need to keep that piece in mind, because in a perfect world, we'd be able to look back in 3 years and adjust the asset allocation. But those of us that have sat in this board for a long enough time realize that that is often not the case, that we do it every 3 years. It's usually longer than that. So I think we just need to be mindful of that as we consider what the options are. I believe this conversation has kind of, I don't hear any objections to the alternative piece of this or the equity piece of this. I believe we're focusing in now on the fixed income portion of the portfolio. I don't know how much more we should discuss today, and if we have a charge for Callan to go back and work some additional numbers, this may be a good way to ask them to look at things the way that some other mixes that people have asked about or are curious about. I think that's the purpose of this exercise. We're not coming. We didn't present this today with the expectation of actually voting on an option, but I think that it's good to know where folks are thinking and where the consultants are thinking when they're looking at these, and what actually information is going into this. So,
John, I'm sorry to interrupt, John. Can I just, if it's okay, just for the record, I want to answer Allison's question, because I think it's a very good question about the transition costs associated with moving out of converts. It's not inconsequential. They're not like we're selling treasuries and the bid-ask spread's really narrow. I think to Robert's point earlier and to the comments that were made by Callan, it's less trafficked in, there are less managers, so it's not to say that it'd be cheap to transition out. And that is one of the considerations I think that the trustees have is, does this make sense? We saw that it really doesn't move the dial in risk, it really doesn't move the dial in return, and there's an expense associated with. I think I couldn't agree more with Ed's comments as well. Maybe a matter of timing, but to your point, we're long-term investors. We don't want to try to lean in and out of strategies necessarily. We want to be a consistent investor. So, there's two sides of the argument to be made. And I think that's a very good point that Allison raised.
No, I appreciate that, Steve. And that's not to say that that's the only issue that I think that we just need to be honing in on one segment of this, because it's the two of the asset classes that we're questioning that are already in the portfolio. I don't know if there's specific questions that people have regarding the asset mixes that we're seeing, but I would encourage folks, if not today, to send Bud an email and to send BAM an email if there's a scenario that you think would be effective for them to run for the next time we have this discussion that we may have omitted.
And 17 we have an asset allocation that maintains convertibles. It's in the presentation.
No, I'm just saying in case, I'm just saying in case people are uncomfortable with 10% in private equity, if they wanted you to run a different scenario, like now would be the time, I think, to raise those, not right this moment, but between this meeting and the next meeting, if there are questions about things that you'd like to see as trustees, I'm encouraging people to reach out to let somebody run a scenario so that we can discuss it.
John, if you'd indulge me, so I'm not going to address any more convertibles, but I did want to comment on the 0.5% in cash allocation. That really doesn't change anything that we're doing. That's actually the way we manage the portfolios now. We always have some cash on hand to meet capital calls and meet beneficiary payments. Usually it ranges between 25 to 0.5%, 25 basis points to 50. So we have capability in-house that we've built out. We've got execution people. I actually hired a gentleman, actually reports into Robert Fang, named Chris Holmes, who's got 11 years of experience as a head of research, a research director at Moody's, who's coming in and putting more of a rigor on any credit exposure we may take. Also, the idea with the cash allocation, it's not tactical. We're not putting money in cash and then we're moving out because we like stocks, or it's simply to meet those cash requirements of the fund. And those investments are typically inside of 2 weeks, well inside 2 weeks. It's really just there for liquidity, but it also recognizes in a more formal way that we have some level of allocation to, again, meet those benefit payments and calls.
In fact, it's been an unrecognized allocation.
Any other, Keisha?
Yeah, I can bring it up in the intervening period. It's really about other way to approach the convertible allocation. I can bring it up later.
That's fine. And look, I think there's no bad questions when it comes to asset allocation, and we should all be comfortable with what we're seeing. And we have the expertise, in this room, and they have deep teams and deep benches that should be able to, run different scenarios for us. And I think that's the important thing, is there are things that we're going to look at in, next meeting, go, hey, I should have asked about the exposure to, what non-U.S. I mean, I asked my question about EMD. I don't think that based on the answer, it makes sense to run a scenario with it, but that's me. I don't know if anybody else has that feeling, but I just want to make sure that we utilize the talents of Callan and the Bureau of Asset Management, because I think that ultimately that's our job, right? Is to make sure that we get the most out of the people we do business with in an appropriate way, that is, but to ask the questions and to ask people to run scenarios and things. So
one other comment, John, that Steve just reminded me. This time around, for the real estate allocation, we combined core and non-core into one asset class, just to give the staff a little bit more flexibility on implementation, but it basically assumes a 60-40 split.
And I'll just say that from where I sit, I think that's completely appropriate. I think that historically as a board, we've always, at the board level, have thought about it as real estate being somewhat core and non-core. And I recognize on the implementation piece that BAM is and the consultants are hyper focused on how that's managed on an implementation level. And we have never, to my recollection, we have never objected to that at the board level. But I think for all of us, in our mind, when we allocate to real estate, we're allocating to real estate and hoping that the best managers are what come between us. Come to us.
Also, just a clarification, not a clarification, just to emphasize a point. Core and non-core real estate, they're all the same assets. They're just in different levels of condition. So core, it's going to be office and retail and student housing and hotels and the like. Same thing with non-core, but non-core, they're typically two broad categories: value added, which means some level of repair, and opportunistic, which means a lot more repair. So it's not to say we're going to put a whole bunch of money in office space because it's cheapening up. It's just, it gives you that flexibility. That's something that I think is misunderstood by a lot of folks. Core and non-core, it's the exact same assets. They're all commercial real estate, but in different conditions that some may need repair. And that's why when you invest in non-core, the returns are higher because there's a little more risk. I have to clean it up and fix it, and then maybe resell it.
So I think this was a really good discussion. I hope everybody else found it extremely helpful. thank you to the Bud and the Callan team, Tom, for walking us through it. And if there's any additional questions, I encourage folks to reach out to Callan, and in turn to the Bureau of Asset Management. And we're happy to, Allison and I are happy to facilitate any questions that we get and move those over to the appropriate folks. And Robert, thank you for shedding some light on some of the nuances of fixed income that we don't live day to day, but you do. So thank you. Okay, so that, I believe that that concludes the discussion on the strategic asset allocation. We do have one more issue, and I'll turn it over to Allison to talk about the Labor Rights Investor Network.
Hi all. I feel like I'm standing between us and lunch, but so I'll be quick. And this is hopefully less controversial than what we just discussed. We have been invited to join the convening committee of a sort of newish formalized coalition called the Labor Rights Investor Network. It is primarily a group of unions and union coalitions that we have been partnering with informally around our shareholder agenda and proposals. And for many years, particularly around human capital management issues in the portfolio companies within which we invest and freedom of association as such. We are the only U.S. public pension funds, all 5 systems have been invited to join, to be asked to be on the leadership team of this. It's primarily the AFL-CIO, the CWA, the Strategic Organizing Committee, which is sort of the remnants of Change to Win, Uni Global, which is the global coalition of service worker unions, such as UFCW, SEIU, et cetera, and their global counterparts in Europe, Australia, Africa, what have you. So we've been asked to join this group. There's no cost associated with this group. It's really lending our name, as you know, all of those folks have much smaller pension funds than we have and are much smaller investors. Yeah, so that is the request. We wanted to bring it to the boards instead of just having the controller sign on, because we felt like this is an important issue that all of the trustees on the boards have really prioritized, as understanding that our long-term returns are really predicated on a long-term sustainable human capital management approach as opposed to short-term exploitation. So I wanted to put it in front of the trustees for a vote.
Am I on? Oh. I just have 2 questions. One, is it a duplicate of CWC? And also, are there no sovereign labor funds, labor organizations?
It is not a duplicate of CWC. CWC is also participating as a member. I don't quite understand exactly what the difference is, but it is not duplicative. And I do not believe there are any sovereign funds involved, but I can confirm that.
So we can take up that vote when we vote later today. So with that, that concludes the public agenda. If there's no other comments from anyone, I will make a motion to exit public session and enter into executive session to discuss specific manager issues. Is there a second? Thank you, Mr. Katzman. All those in favor, please indicate by saying aye. And
Aye.
any opposed?
Aye.
Any opposed?
Aye.
Hearing none, motion carries. We are now in executive session. I would ask that anyone, any member of the public, so I'm going to turn it over to Melanie, and then I'll turn it back over to the chair.
The board agreed to join the Labor Rights Investor Network. The board agreed to commit funds to 2 real estate investments and 2 alternative credit investments, the details of which will be disclosed at a later date.
So with that, I'd like to make a motion to adjourn. Thank you, Mr. Katzman.
All those in favor?
Aye.
Aye.
We stand adjourned. Thanks. Thanks, everybody. William, thank you for being a stenographer today. We